Hi guys, this is Hustle Hub and today we're going to talk about value investing. But before we get into the video, make sure to subscribe to the channel, smash the like button and let's get started. Value investing is an investing philosophy which was first invented by Columbia Business School professors Benjamin Graham and David Dodd. The thought process behind this philosophy is that there are companies that the overall market sometimes undervalue. It can happen because people are afraid the company won't do well in the future, or it's in a sector that won't grow that much. The stock prices sometimes are the result of emotional decisions made by other investors and speculators. So, an investor who bases his decisions on quantitative methods can take advantage of these market imperfections and profit off it. Benjamin Graham explains this in his book, The Intelligent Investor, and if you want to check it out, you'll find the link in the description. In his book, he makes a simple example. He compares the overall market to a very moody person. This person executes his trades based on his emotions. One day, he is very optimistic and is ready to pay a premium for the share he's buying. Another day, when he's sad, he's ready to sell the share for a bargain. On the other hand, the intelligent investor, who's not influenced by emotions but only by quantitative research, is ready to take advantage of the situation and buy low and sell high. So, what are the metrics used by the intelligent investor? The metrics used are price to book ratio, price to earning ratio, and dividend yield. The price to book ratio is the value of the whole company divided by all the assets owned by the company, for example, real estate, machines, cash, etc., minus liabilities, for example, debt. If the price to book ratio is 1, it means that the company is valued exactly like the assets that it owns. Most of the time, the ratio is over 1, but Graham was able to buy companies that had a ratio that was less than 1. The second metric, price to earning ratio, is calculated by taking the market capitalization of the company, which means the overall value of the company divided by its earnings. Graham said that a good rate is under 15, but it depends on many different factors. The company may have an attracting ratio, but it is very likely that it will become less profitable in the future. It can be because the company operates in unstable countries, so the market can worsen. Also, bonds interest rates influence the stock's ratios. That's because if interest rates on safe bonds rise, people will buy more bonds because it offers a guaranteed return compared to stocks. The last ratio is the dividend yield. The dividend is the interest that rewards the stockholder with a part of the company's earnings. For example, let's take two companies with the same price to book, price to earning ratios, and same growth perspective. If the first company only gives a 1% dividend, but the second gives 2%, the value investor will pick the second company. This all looks very rational, but there are different investing strategies that focus on growth perspective rather than value. For example, you'll notice most of tech companies listed on stock markets have very high multiples and no dividends. Those who buy those stocks may have very good results as well, but they have a different investment philosophy. Another example is cryptocurrencies. Bitcoin, for example, is not a company. It doesn't produce dividends. Those who invest in Bitcoin do it because they think people will be willing to pay more for that very same thing than today, even though it doesn't have tangible value. Anyway, those who bought Bitcoin, Ethereum, and others very early on made stellar returns. The value investing philosophy became very well known because it was the one used by Warren Buffett. At the start, he was following Graham guidelines and based his decisions only on calculations, by buying only companies with extremely low ratios, taking the profit and backing out. Later, he started buying very strong companies that he thought would last a lifetime, even though the ratios were slightly higher. In his own words, companies with a moat. The moat is the water that surrounded medieval castles in order to protect them from invaders. The companies with a moat are those who have something that protects them from competitors. For example, Amazon has such a big audience and well-organized logistics that it is hard for anybody to compete with them. Nike has such a strong and recognizable brand, which makes it very hard for others to compete in sportswear industry. As a matter of fact, one of Buffett's greatest deals was when he bought shares in Coca-Cola after the company flopped with the new Coke attempt. He bought even though the company had a few bad quarters, because it had such strong brand that was going to bounce back whenever it would have got back on track. Make sure to check out Warren Buffett's biography on our channel and also not to miss the other pills. Thank you guys for watching the video, make sure to subscribe to the channel, smash the like button and turn on the notification bell. See you next time with another video for you. This was Hustle Hub.